Welcome to F9 Financial Management. In this section, I will go over the valuation of debt and other financial assets. So, if we wanted to get debt financing, we would approach a bank and get a loan, or at least attempt to secure a loan. This is the same for small businesses. But large businesses and organisations can issue debt. You've already learnt about debt that can be issued and traded on the financial markets. But how does the company value this debt, and how does the investor put a value on this debt that they invest in? Traded debt takes on many forms, and they are called loan notes, loan stock, debentures, and bonds. They are all traded debt, and investors assess their value based on their expected return. In this section, I will cover the valuation methods to value irredeemable debt, redeemable debt, convertible debt, and preference shares. What is the market value based on? As I said, the value of traded debt and any asset, when you think about it, is based on the expected returns of the asset. Debt is traded in nominal amounts of $100 and offers an annual coupon rate. Its value is dictated by its expected returns. The expected future returns are then discounted to the present value based on investors' expected rate of return. What affects expected rate of returns? As I have said before in earlier videos, the risk-free rate of return affects the expected rate of return. This will set the boundary for what is the minimum return investors expect. If banks offered a 10% return for monies held on deposit, then investors would expect to receive more than 10% return for their investment. If the next year the banks lowered their return, only offering a 4% return, this would mean that investors would require a lower rate of return for their investment, and the value of debt assets would increase. The current value of debt is determined by the current expected returns of that asset. So, for example, an investor expects their investment to be worth $1,000 in 5 years' time, and the current cost of finance is 10%. We use the discount factor at 10%, which is the cost of finance or the investor's expected rate of return, and get the current value of the investment. It is $620.92 if you calculated it. Now, between today and 5 years, a lot can happen, completely changing the value of this return. But today, the expected return of this asset, which is expected to be $1,000, so this is what we base the value on. So, how do we value irredeemable debt? Let's start with what it is. It is debt that has no fixed repayment date. Instead, the company pays interest on the debt annually. The interest rate is also referred to as the coupon rate, which is paid in perpetuity. So let's look at an example. Longevity Incorporated has 6% irredeemable debt in issue. Investors required a return of 9%. What is the value of the debt? We value this debt as follows. We assume $100 nominal value at 6%. We know that $6 are being paid to investors annually. We also know that this is irredeemable, so technically this will be paid forever. What does that tell us? It is paid in perpetuity, so we must discount it on this basis. How do we get the discount factor of a perpetuity? 1 divided by OR, where OR is the discount rate. It is the expected market return. So here 1 is divided by 0.09, which is the expected market return, 9%. So what is the value of this irredeemable debt? $6 multiplied by 1 divided by 0.09, which is $67. Next, how do we value redeemable debt? Redeemable debt is repayable on a certain date. It is issued and has an interest rate attached to it. Sometimes it is repayable at a premium. Let's look at how it is valued here. XYZ Incorporated has 5% debt that is redeemable to investors in 5 years. The investor's expected rate of return is 6%. Knowing what you know from valuing irredeemable debt, and that its value is based on the expected returns, pause this video and calculate the value of XYZ Incorporated's debt now. Have you done it? Okay, so we assume that the nominal value is $100, so the question does not mention a premium. So at the end of 5 years, the $100 will be repaid to investors, and they will receive 5% interest annually. So we also know that investors expect a 6% return for their investment. So let's put this information together and calculate the present value of the future returns. In this table, you can see the annual cash flows. The investors receive $5 a year, which we get from the coupon rate. In year 5, they also receive back their initial investment of $100. These cash flows are discounted at 6%, which is the investor's expected rate of return. Total, the present values, and the market value is $95.79. This should look familiar to you. It is very similar to valuing projects. Now, what if XYZ Incorporated paid a premium of 20% after 5 years? Assuming everything else remains the same, I want you to pause this video and calculate this. Done it? So let's start with calculating the premium that they will pay. It is 20% of the nominal value. So that is $100 multiplied by 20%, which is $20. This means in year 5, the investor will receive $120. You can see the calculations on this table. Now, the investment is worth $110.74, since the premium increases the expected return of the asset. Its value increases. Because as you know, the value of the asset is based on its expected returns. Now, let's look at convertible debt. What is it? This is initially debt. However, on the repayment date, the investor can choose to convert their debt into a fixed amount of equity. So, for example, Indigo Incorporated has 5% debentures that are convertible in 5 years' time into 30 shares in the company. The current share price is $2, and this is expected to increase to $5.50 in 5 years' time. Investors expect an 8% return per annum. So, what is the market value of these debentures? First, we must find the future expected returns. In 5 years, investors can choose to receive their initial investment of $100 back, or they can receive 30 shares which are expected to be worth $165 in total. Well, looking at this, what would you choose? I hope it's converting the debt to shares. It's worth $65 more. Remember, they don't need to keep them. They can sell them on the stock market and receive $65 cash more than their initial investment. Pause the video here and calculate the value of this convertible debt. Have you done it? So, in the table you can see the annual interest or coupon rate of 5%, which is $5. And then in year 5, the expected value of the shares is calculated, and the value of the investment is worth. Now, I know you are thinking that the share prices could just as easily fall, and you're right. The valuation of the convertible debt is only based on the expected return at the time, and as the expected return changes, so does its value. So an investor may ask, or an examiner may ask you, what is the floor value of this investment? How low can it go? So let's look at the example again. What if the share prices do not go up in value? So the investor will have the option of their $100 initial investment, or $30 worth $2, so $60 in total. Now we calculate the floor valuation as follows. See the table. It is $88. The floor valuation is how low this investment can go, and in this case, the investors will get back their initial investment of $100. Now, let's look at valuing preference shares. These are an interesting mix of debt and equity, and you have heard a lot about them. But how are they valued? Like debt, there is redeemable and irredeemable preference shares. They pay a fixed interest rate or coupon rate, which is paid annually. Let's look at an example. Preferred Incorporated has 10% preference share capital, and investors' expected return is 5%. Pause the video and calculate this. Have you done it? Was it familiar? Since the question didn't mention anything about redemption date, I am going to assume that there is none, and that 10% or $10 will be paid into perpetuity. So what is its value? Like irredeemable debt, we find its value as follows. So it's $10 multiplied by 1, which is divided by 0.05. That's the 5%, which is the investor's expected return. And that equals $200. Now, what if the company sold these preference shares that were redeemable after 5 years? How would you calculate that? Pause and give it a go. Have you done it? Okay, let's look. So it is just like the redeemable debt. The annual interest payable is 10%, which is $10 per year, discounted, and at the end of 5 years, investors receive back their initial investment. Now, just to finish off, I want to discuss the interest yield and the redemption yield. The interest yield is defined as the coupon rate divided by the market value at 100%. So ABC Incorporated has 5% debentures trading at $15. The interest yield is $5. Redemption yield. This is the overall return per annum. The interest plus any gain on repayment. Thank you.